Bitcoin just dropped. Again. And for many people watching this right now, your portfolio probably looks like a murder scene. Let's be honest, it sucks. You check your phone every 10 minutes, hoping it'll bounce back. You start questioning your decision. Should I sell? Should I wait? Should I buy more? But here's the truth. Every time Bitcoin crashes, the same cycle repeats. Panic, fear, headlines screaming, "Crypto is dead." And months later, a quiet recovery that makes millionaires out of those who stayed patient. So in this video, I'm going to tell you exactly what I'm doing right now, how to survive this crash, and maybe how to turn it into the best opportunity you'll ever get. But first, let's get something straight. Bitcoin crashing isn't new. It's part of its DNA. If you've been in this space long enough, you know this feeling, the gut punch, the disbelief, the regret. In 2013, Bitcoin fell from $1,100 to $150. In 2018, it crashed from $20,000 to $3,000. In 2022, it collapsed from $69,000 to $16,000. And yet, here we are again. Every single crash before this one has led to one thing, a bigger comeback. The market doesn't reward emotion, it rewards conviction. But I get it. That's easy to say, harder to live through. Because when you see red candles everywhere, the logical part of your brain shuts down. The fear takes over. CNBC starts running stories saying Bitcoin has no intrinsic value. Your friend who never liked crypto starts texting you, "I told you it was a scam." But remember this, nobody made history by following the crowd when the crowd was panicking. So let's zoom out. Let's understand why this is happening and what we can actually do about it.
Every time Bitcoin drops, everyone wants a villain. People say, it's the government, it's the Fed, it's whales dumping, or maybe Elon Musk tweeted something again. But the truth, there's always more than one reason. When Bitcoin crashes, it's rarely because of a single headline or event. It's a cocktail of fear, macroeconomics, liquidity, and human psychology, all shaken together to create a perfect storm. So let's break down the biggest reasons behind this recent drop. Number one, the Federal Reserve and interest rates. Let's start with the big one, the Fed. Every time Jerome Powell steps up to a microphone, crypto traders hold their breath. And for good reason. Interest rates are the oxygen of this entire financial system. When the Fed raises rates, it makes borrowing money more expensive. That means people and companies have less money to throw into risky assets like Bitcoin, tech stocks, or NFTs. Instead, they move their cash into safe investments, bonds, treasury yields, or money market funds. So when the Fed says, we might keep rates higher for longer, the market translates that into less liquidity, less risk appetite, less Bitcoin demand. Here's what usually happens. The dollar strengthens, stocks drop, crypto bleeds, fear spreads. And yes, we're in one of those cycles again. The Fed isn't exactly trying to kill Bitcoin, it's trying to cool inflation. But when it does that, it indirectly sucks the air out of speculative markets. Bitcoin gets hit first. But here's the key insight most people miss. Bitcoin doesn't die because of high interest rates. It rests. It consolidates. It builds a new base. It waits for the next wave of cheap money to come back. So if you zoom out, Bitcoin is just breathing in between cycles.
2. Global economic uncertainty. Next, the global economy. Wars, elections, supply chain disruptions, oil prices, these all ripple into crypto whether we like it or not. When uncertainty rises, investors tend to move to safe assets like gold or the US dollar. Bitcoin should act like digital gold, and sometimes it does. But during panic phases, it still trades like a tech stock. That's why when geopolitical tension spikes, Bitcoin often drops first, before recovering later. For example, during the 2020 pandemic shock, BTC fell 50% in 2 days. During the Russia-Ukraine invasion, BTC dipped hard before bouncing back. And now, with rising global tension and slower economic growth, the same pattern is repeating. It's not that Bitcoin is broken, it's that investors temporarily forget what it's designed for. When the world is scared, people don't care about philosophy or decentralization, they care about survival. So, they sell. And that's where opportunity quietly starts forming. 3. Liquidity drain in the crypto market. Let's talk liquidity, the lifeblood of any market. When liquidity dries up, even small sell orders can cause massive price swings, and that's exactly what's been happening. Since late last year, liquidity on major crypto exchanges has been falling. Some of the big market makers, the companies that keep prices stable, have reduced their exposure because of regulatory uncertainty and tighter global rules. That means there's less depth in the market. So when a whale sells $100 million worth of BTC, it crashes harder than it used to. Combine that with the rise of spot Bitcoin ETFs, where big institutions hold BTC off exchanges, and you get a weird situation. Bitcoin is scarcer on exchanges, but prices still swing wildly because there's less day-to-day trading liquidity. This isn't all bad. It just means volatility is amplified. And volatility, for long-term investors, is an opportunity in disguise.
4. Media panic and retail fear. The media plays its part too, beautifully. When Bitcoin goes up, they say, crypto is the future. When Bitcoin drops, they scream, Bitcoin is dead! Again! Headlines feed emotion, and emotion moves markets. It's not that journalists hate Bitcoin, it's that fear sells clicks. When CNBC, Bloomberg, or even Reddit threads flood with negative sentiment, retail investors panic sell. They dump their holdings at the worst possible moment, right into the hands of whales who buy at discounts. And then, months later, those same outlets will publish Bitcoin surges 80% from lows, like they didn't just cause half the panic. It's a cycle as old as Bitcoin itself. 5. Whales, leverage, and liquidations. Here's another inside baseball reason most retail investors never see. Liquidations. When traders use leverage, borrowing money to make bigger bets, it works great while prices go up. But when Bitcoin dips even a little, those over-leveraged positions get liquidated automatically. That means their holdings get force sold on exchanges, which pushes the price down further, triggering even more liquidations. It's a domino effect, a cascade that looks like a crash, but it's really just automated panic. And you can see it live on data dashboards. $300 million liquidated in 1 hour, $500 million in 24 hours, and suddenly Bitcoin's down 10% with no major news. That's not investors changing their mind, that's the market cleansing itself. So when you see those giant red candles, remember, most of it is leverage getting wiped out, not conviction leaving the market.
Regulatory uncertainty. Let's talk about everyone's favorite topic, regulation. In the U.S., the SEC has been tightening the screws on crypto exchanges and tokens. Every time a new lawsuit or headline drops, the market reacts instantly. But here's the nuance. Regulation itself isn't the problem. Uncertainty is. Institutions and serious investors love clarity. They just want to know the rules so they can play the game confidently. Right now, those rules are still being written. And until they are, big money stays cautious, meaning less capital flowing into Bitcoin. But once regulation stabilizes, and it will, you can bet institutional adoption will accelerate faster than ever. Ironically, the very thing that's hurting prices today could be the foundation for the next bull run. Trap. This one's psychological, but crucial. Bitcoin's last big run made everyone think it only goes up. People expected $100,000, $250,000, even $1 million by 2025. When those expectations aren't met, frustration builds. Investors get bored, they sell, they move to meme coins, or they leave crypto entirely. And when sentiment hits rock bottom, that's when accumulation quietly begins again. Markets don't rise when everyone's hyped. They rise when nobody cares anymore. On-chain data doesn't lie. If you look deeper, beyond charts and headlines, the blockchain itself tells a very different story. On-chain data right now shows long-term holders are not selling. Exchange reserves are dropping, meaning coins are being moved to cold storage. Network activity remains stable. So even though the price looks ugly, the fundamentals are quietly strengthening. Short-term traders panic, long-term believers accumulate. That's exactly how wealth shifts hands in every cycle.
Final thoughts for this section. So, why is Bitcoin dropping? Because the world is adjusting. Money is tightening. Fear is spreading. And weak hands are leaving the table. But guess what happens every time that cycle repeats? Bitcoin doesn't die, it resets. Crashes don't destroy long-term investors. They transfer wealth from the impatient to the disciplined. So before you hit that panic sell button, take a deep breath and zoom out. Bitcoin has survived every single storm it's faced, and this one will be no different. The psychology of a crash. Let's be real. Bitcoin crashes are not just financial events. They're emotional events. When Bitcoin drops 20%, it doesn't just hit your portfolio, it hits your brain. It triggers fear, anxiety, and regret. You start questioning everything, your decisions, your timing, even your intelligence. And that's exactly how markets manipulate people, not through numbers, but through emotion. Let's talk about what really happens in the mind of an investor when Bitcoin crashes. Fear and greed. Every market, stocks, crypto, real estate, runs on one eternal engine: fear and greed. When prices are high, greed whispers, "You're missing out. Everyone's getting rich except you." When prices fall, fear screams, "It's over. Get out before you lose everything." This cycle repeats endlessly, and Bitcoin is the most dramatic example of it. In bull markets, everyone's a genius. You see tweets about people turning $500 into $100,000, and your brain says, "I should be doing that too." But in bear markets, silence. Nobody posts their portfolio, nobody brags. That's when the real investors quietly build their positions, while the rest are paralyzed by fear. The trick isn't to escape emotion, it's to recognize it and use it as a signal. When greed is everywhere, it's time to be cautious. When fear dominates, it's time to start looking for opportunities.
2. Loss aversion. Why losses feel twice as painful. Behavioral economics has a rule. People feel the pain of losing money about twice as strongly as they feel the joy of making it. That's why most investors sell at the bottom. They can't stand watching their portfolio shrink day after day, so they cut losses right before the market recovers. It's not stupidity, it's biology. Your brain evolved to avoid danger, not to manage volatility. In the wild, ignoring fear got you eaten by a tiger. In markets, ignoring fear can make you rich. But evolution hasn't caught up yet. So every Bitcoin crash feels like danger. Your body literally goes into survival mode. Faster heartbeat, stress hormones, panic scrolling through charts. You're not reacting to numbers, you're reacting to fear of loss. But here's the irony. The biggest financial gains come when you act against that instinct. When everyone else is running, the few who walk toward the fire build wealth for the next decade.
4. Confirmation bias. Hearing only what you want to hear. During a crash, investors don't look for truth. They look for comfort. They read news and watch videos that confirm what they already feel. If they're scared, they look for content saying Bitcoin is dead. If they're bullish, they only watch, "This is your last chance to buy before 100K. That's confirmation bias, filtering reality to protect your emotions. Smart investors do the opposite. They expose themselves to uncomfortable information. They listen to people who disagree, because truth lives where discomfort starts. So if you're watching this video during a crash and it's making you a little uncomfortable, that's good. It means you're thinking. And thinking, not reacting, is how you make money in this market. 5. The pain of doing nothing. There's another emotional trap that's less talked about. The pain of waiting. When prices fall, some investors panic sell, but others, they freeze. They do nothing. They check prices every day but never act. And that paralysis, that constant state of maybe tomorrow, can be just as destructive. Because opportunity doesn't shout, it whispers. If you wait for the perfect moment, you'll miss it. If you wait until the fear is gone, the price will already be higher. So the question isn't just, should I sell or should I buy? It's, do I have the discipline to act when it's hardest to act? That's what separates professionals from spectators.
6. The emotional inversion of Bitcoin. Bitcoin's volatility flips normal human emotion upside down. In most areas of life, when things go down, it's bad. When things go up, it's good. But in investing, it's the opposite. When prices go down, your future potential goes up. When prices go up, your opportunity goes down. That's why experienced investors love bear markets. They're the only time they can buy freedom on discount. If you change how you feel about red charts, you'll change how you profit from them. Fear becomes excitement. Downturns become discounts. It's not about predicting the market. It's about rewiring how you respond to it. 7. The Stoic Investor Mindset. Let's bring it home with a mindset shift. The best investors are not prophets. They're Stoics. They understand that they can't control the market, only their reaction to it. Marcus Aurelius said it best. You have power over your mind, not outside events. Realize this, and you will find strength. Every Bitcoin crash is a test, not of knowledge, but of temperament. Do you panic or do you prepare? Do you follow the crowd or do you follow your conviction? Because long-term wealth isn't built on IQ, it's built on EQ. Emotional control is your greatest edge in a market that thrives on chaos.
Final thoughts. So, yes, Bitcoin is crashing. But the real question isn't, why is this happening? It's, how will I respond? You can panic and repeat history, or you can study the psychology behind it and break the cycle. The smartest investors aren't the ones who know the most, they're the ones who feel the least when everyone else loses control. When you master your emotions, you stop being part of the crowd and start becoming part of the story.